Good Wednesday morning, Market Chameleons. Everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with myself, Will McBride, and the main man all the way from South Jersey, where I hope it's sunny and beautiful, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. We got a request from Jim all the way from Southern SoCal. He was asking, he says, I went back and watched Monday's show on call spreads. Great show. Would like to see more on call spreads. So good stuff.
Awesome. Thank you. Okay, sure. We'll do some. Let me know if you have a specific question on a call spread or a stock you want to take a look at, and we'll do that. But yeah, no, thank you. I think we did a webinar with Interactive Brokers, but that was on put spreads. Is that right? Well, I think it was.
Yeah, I think that was last one on put spreads.
Yeah. Okay. So before we get started, let's just read the disclaimer really quickly, and everyone keep in mind that Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And there we go. I'll share my screen. If you guys are joining us for the first time and you have questions, put those questions on the live chat on YouTube. Will's watching them. He'll read it back to me. If you want to come on a show and ask your question live, we also provide a link to Zoom. If you click on that link, it takes you over to Zoom. Once you're over in the Zoom platform, there's a button there, raise your hand. Click on that. You don't have to turn on your video camera, but you'll be able to ask your question direct. Everybody will be able to hear you. Those are two ways to ask questions. While we're waiting for questions to queue up, what I'll start out with today is we'll take a look at the pre-market report, see what's trading in pre-market hours. We had some questions about implied volatility, crush, and implied volatility as it relates to short-term options. So when we're looking at weeklies or options with a couple of days to expiration, in the Black-Scholes model. So I'll discuss that a little bit. We also published yesterday a new feature, the dividend discount model. So I'm going to try to get to that as well quickly. So
wow,
those are
a lot going on this morning.
Yeah. So we're going to try to see if we could cover all that today. But if you have questions along the way with anything we're talking about, well, stop me and I'll try to answer those. Okay. So let's start out pre-market report. These are stocks trading in pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I see 49 stocks made our percentage gainers list, 142 on percentage decliners list. So right now, from that perspective, we're looking like a more bearish bias at the open. I'm going to filter out this list to just S&P 500 stocks to see what's
amazing looking at that list before you depart from it. That BBBY is, it's these meme traders look like they're back again.
Right, up 40%. Right, so, and I think that's because Walmart reported earnings, and it looks like a lot of those retail companies have been popping. Looking at the retail sector might not do so badly in this environment. So I think that they were up big, but Target reported today and looks like they are weaker at the open, not like terrible because they did have some big gains yesterday. So it doesn't look like terrible, but I didn't get a chance to read their report.
I think also the investment group led by, and I don't know the individual's name, but he took over GameStop. He's the CEO of GameStop now. They took an options position, I guess, in leaps in BBBY. So that was another reason. So people jumped in. I don't know if it showed up on our unusual option report, but that was something that they were mentioning this morning.
And so far, I think this is it's a weird type of situation we're in because, they want to slow down the economy, but we're at full employment. And when you're at full employment and and the job market is hot, the wages are increasing. It doesn't feel like a recession. It doesn't feel like you're slowing down, and people are still spending money, right? So out there, even in the stock market, it doesn't right now. There is no feeling like, hey, our economy is bad or it's slowing down. I think it's quite the opposite. And you still see people saying, I might as well spend today, right? Because prices are going to go up tomorrow. And you could see also, if you take a look at the savings rates and the money markets, they're paying near zero. So you're still getting punished. If you're just a regular person working and you're putting your money into a bank, you're still getting punished for saving. Like they're telling you either go spend your money or you're going to get devalued. So whatever you put in the bank today, you put in $1 in the bank today, in a year from now, you basically have $1. You're not earning any interest. You'd have to go out and buy treasuries or something. But if you're putting it in a bank, most banks on average, there are some banks that have raised their interest rate, but most banks on average, they're holding their rates near zero, which means that even at 2% inflation, you're still losing, right? You're still losing for saving. You're still getting punished. So I think those inflationary pressures still exist. And, I think gas prices are coming down. I think this is important. I just want to mention before we move on, but we see gas prices coming down, oil prices coming down, and that seems to be good for inflation, right? That's good for inflation, obviously, because that impacts everybody. Gas prices are taxed on everybody.
Yeah, no, you feel it. It feels, it feels better now that, I'm not paying over $5.
Exactly. That's going into everybody's model, right? Everybody's saving.
AD, you want to either jiggle your mic or get closer to it. You've gone underwater. Let me mute myself.
So gas prices are coming down. The models are taking that into account.
Try jiggling again. Still
you can't hear?
That's
Do you want
good
me to
now.
log out?
Nope, that's good.
All right. So when gas prices come down, oil prices come down, people are feeding that into their economic models and saying, well, now people are going to save X amount per month on average, and a percentage of that is going to go towards, consumption. So whatever, I'm just making numbers up. If $300 all of a sudden people are saving per month, and 200 will go towards consumption, you're feeding that into your models, and all of a sudden, buy stock. But one thing to consider is, why are these gas prices going down? And, I don't have a good model for it, but I could tell you that our strategic reserves in oil has been depleted by 20%, right? So that's weighing in, that's increasing the supply of oil out there. But it's not sustainable forever, right? Eventually, you're going to run out of strategic reserves to sell. And I believe that it's even worse than 20%, because the way they're selling it, there's different grades. I'm not an expert in it, but I have been reading a little bit about it, that there's different grades of this, of oil, and the way that these companies are bidding right now, they're selling the best of it, right? The ones that are the easiest to refine and so forth. And from what I'm reading is, by November, they may have depleted 50% of that, so it's not sustainable. And I also think that up until November, they're relaxing the mixture to produce gas. So I think that will go back as well. But some things to consider is, like, yes, gas prices are going down, but the government is involved in that, and they are increasing the supply. I do believe that in this Inflation Reduction Act that they just passed, that they're going to give more permits to drill, and they're going to give credits for like solar panels and electric cars. But the experts say that that could take years, before we feel it. It's not going to be like an immediate effect. So I would say like November, December, January, we'll see how that plays out. What are they going to do there? Because right now, America's producing something like 11 million barrels of oil per day, and the US is adding 1 million out of the strategic reserves. So what happens if we take that out, and what happens if we need to buy it back, right? Because eventually you need to go and fill that. The government needs to start. It's gonna convert from a supplier to consumer, right? Eventually they're gonna need to buy that back. So, I think that could be what we're feeling might be temporary. That's my belief, that what we're feeling might be temporary. Like when we hit those dates, November, December, January, it's around there. I got to go reading back where it starts to slow down. All right, if there are no questions, let me move on to what we're going to do. S&P 500. So let's take this pre-market report, filter out to the S&P 500 because we want to take out the small cap stocks, ETFs, leveraged products, all those other things, just to see what's going on in the S&P 500 stocks. To do that, I'm going to use the filters above in ETF, drop this down and select one of the ETFs. So SPY, that's the S&P 500 ETF, and select that. Now this list got filtered out by SPY holdings, which are the S&P 500 constituents. And here we see 2 stocks made our percentage gainers list, 22 on the percentage decliners. So right now, from that perspective, we're setting up for more bearish bias at the open. There are no questions on the pre-market. Well, let me start out with implied volatility. Let me start out with implied volatility and the questions for the weeklies.
Right.
So I guess the first thing, I think I was on Walmart when that question came up. So the first thing was the Black-Scholes model. So implied volatility is derived value, and what it does is it takes a price of an option, right? And that's what models usually do. They'll take the price. They'll start out with here's the price of an option, or here's the price of a stock, and that price reflects some kind of future expectation, right? An option's forward-looking, a stock is forward-looking, future, all that. It's forward-looking, and when we start out with the price, we have to create a model to figure out what are the expectations of the market based on this price. So a lot of times you'll hear like the futures are, pricing in a 75% probability of a half a point, increase or whatever. You hear that a lot, on the news or when you read about it. And that's coming from a model observing a price, right? The futures, it doesn't actually say that, right? The futures just has a bet. It's a price on the future value of something. And you have to work your way backwards to figure out what is that price implying. And that the Black-Scholes model, what it does is it takes the price and works backwards by saying, what is this price? Based on this price, what are the markets implying the average daily volatility of the underlying stock? All right, that's how the Black-Scholes model works. It says if I work backwards from the price, what is this price implying? And the Black-Scholes is saying the average daily volatility of the stock, that's your implied volatility. Okay, and on the other hand, you could work and plug in your input and say, well, if I think the average daily volatility of the stock is 20, right? So I could plug in my own volatility here. Let's do it right now. custom volatility, if I think the average implied volatility between now and expiration, August 19th, will be, let's say, I think it's going to be 22. I could plug that in, and then based on that, I could generate a theoretical value of what this option would be worth. Okay. So that's what the Black-Scholes model does. Let me just go back to best fit. And then the question is, well, why is this not coming off? So the question is the Black-Scholes model a useful model for like weeklies or daily options? And and this is why a lot of times people tell me, like, cover weeklies, cover dailies, and we talked about yesterday that the Black-Scholes model is not a good model if you're looking at an earnings move, right? We said, because it doesn't have that component. The Black-Scholes model does not actually derive an earnings move. It only derives an assumption of average daily volatility. So the Black-Scholes model is less and less effective the shorter term you go. Weeklies are worse. Dailies, you have one day to go, it's less effective. And the reason is that when people trade implied volatility, right? Implied volatility versus realized volatility, the assumption, the theory is that volatility is mean reverting, that there are going to be periods when volatility is elevated. There are going to be periods where volatility is very low, but it's mean reverting. But mean reverting means over time, right? That it takes time to mean revert, because you could have a longer period of high volatility, then low volatility, and it goes around the mean. But to revert, it takes time. It doesn't happen in a minute. It doesn't happen in an hour. It doesn't happen in a day. It may not happen in a week, right? Because you could be in a period of very elevated volatility, and the historical volatility will not apply. So having said that, as you get closer and closer in time, what happens is you're trading less volatile. The model is less effective, and your model turns into more of an informational, who has better information to model the potential distribution of returns in the short term. Okay, so you're trading more. Let me see here. Down here, here August 19th, we see 3 days to go. This is yesterday. The straddle, the option straddle, is implying a 2% move, and that's really, is it going to move 2% or not? Right. The volatility, if you can model the volatility, in a very short term, maybe, but it becomes, that Black-Scholes model, in my opinion, becomes less and less effective. It's like trying to plug in, like, think about it this way. If you have a minute to expiration, does the Black-Scholes model matter? Are you even going to look at it, right? You're just going to look at the options and say it's either, going to move through it or not. Go to an hour to expiration. Black-Scholes model is not going to help you. Even 1 day, I don't think it's relevant as much anymore. Because when you're talking about a model that's based on a mean reversion, it takes time. And as you get closer in time, and a lot of people say, well, cover weeklies or whatever, you're talking about, then you would have to have information that can impact the stock price and movement in the short term, right? So you would have to know what kind of news, is earnings, conferences, anything that can make the stock move, correlated products, like what is, Target is coming out with earnings. Can that impact the Walmarts? What are the other products? What are the markets implying the move? Market moves, economic moves. Are there any kind of government economic releases that could impact it? Order book, is the order book getting thinner? Is it getting thicker? Where are the big resting orders sitting? Order flow. All this starts to feed into a model that's more effective in the short term, right? The longer term you go, that information advantage diminishes, because nobody knows in 3 months from now what's going to happen, or 6 months from now. But in a very short term, you can compile information that will give you an informational advantage. All right. So I think that this was the question: how is the Black-Scholes model and implied volatility? Is it that useful for weekly options? And I would say no. And I would say this, that if I was, and I'm not a registered investment advisor, I'm not giving anybody advice, but if I was talking to a friend of mine who was a retail investor, and he asked me, should I trade weeklies or go out 3 months, I would say, do not trade the weeklies unless you really feel confident about something. And and you're not gonna why are weeklies pushed on people? Like, you're gonna hear weeklies and by brokers and so forth, because that's what they do, is they generate more fees, right? So they're going to push into things that generate more fees, because you got to trade them more frequently, and you have less of, and you're considered more of an uninformed trader in the shorter term, right? So the shorter term, you're more uninformed than people plugged into the system. So you're gonna probably hear from everywhere that you should be trading weeklies. Even dailies, they'll trade, because that's how they generate transaction fees. But I would say that you're better off going out further in time as a retail investor, because that informational disadvantage diminishes as you go out further in time. And if you're looking at implied volatilities that are maybe mean reverting, if that's your strategy, then going out further in time is better. But talk to your broker, see what he says. Bring that up to them, bring it up to your registered investment advisor. So I think that answers the question.
Yeah, that was the question. Rob
Okay.
did have a question when you were discussing that. I didn't want to interrupt your train of thought. He was asking, is there somewhere on the site where you can see mean reversion?
So, well, a mean reversion is a concept that volatility, right? It cannot go up forever like a stock price. Stock price can keep going up as long as it makes more and more earnings. It can keep going up, and a stock could go down to zero and that's go out of business. But volatility cannot go up forever, because you will need it to move around in bigger and bigger gyrations, right? That's what volatility is, and it can't do that. It's not sustainable, because it just takes a lot of money to keep forcing it to move up and down, up and down. So usually, as stocks over time mature, and that you could predict their earnings a little bit better, their revenue, they're giving more guidance and so forth, you see volatility, it starts to kind of trade at its mean volatility. So when we talk about, I could go here, let's go to, stock volatility, Walmart. So here's the stock volatility for 1 year. You could use different, these are two lines using close to close volatility and open, high, low, close. And what we're doing is just looking at log returns, right? Daily log returns. So you could see here, that it moves it could move up, it could move down, it could move back up. And, some of it has to do with earnings. So it's a little bit seasonal. But here you could see that, wherever trade, maybe what, 19, let me see, historical vol. So here's the 1 year volatility 21, 60-day 24, 26. So, it can tick up, and then you have your low and high. So the idea there is, from our observations, it trades, from a low of in a year 13.8 to 33, in the last 60 days 19 to 31. So it's probably trading, around that, in that band, right? And every stock is different. You're going to have stocks that have a big vol of the vol, right? So sometimes the volatility will drop and sit there for a long time, and other times it will go way up, and stay up there. So that, each stock kind of is different in that way. But yeah, here's a, a daily chart. Let me see, here's implied volatility. Let's do it this way. Here's the implied volatility here for 5 years in Walmart. So you can see it came up, then comes back down, comes up, sometimes comes back down. If we looked at the 20-day moving average, right, here's the stock volatility. So you could see here the stock volatility is that, let me get rid of it, is that blue line, and the implied volatility is moving around it. So this is the 252-day moving average of the stock volatility. So we're smoothing it out by averaging it out more, and that's the daily implied vol. Right. So that's one way to view it graphically. Oh, you know what? I didn't cover on earnings, implied vol. Huh?
All right. Perfect. Let's go to it.
Yeah. So having said that, when we talk about right here, implied vol crush, why do people talk about implied vol crush? And if you're doing the straddle, front month straddle, you're not really trading an implied volatility crush as much as the move. It's like the straddle, it's either the stock's either going to move by the amount of the straddle price or not. But if you sell straddle that implies a 5% move and the stock moves 10%, implied volatility will not matter because you lost on that straddle. The implied volatility could go to 0. You still lost on that straddle because you have to buy back for a higher price, right? It's because it's going to be in the money, right? One of the options is going to be in parity by more than you sold both options. So implied volatility from that perspective does not make sense. So when we look at implied volatility, we go out further, and we go out at a stock and an option further out in time. So we're talking about 30 days out, right? That's where we look at least 30 days out. You might want to go further. And we assume you're doing something like a calendar spread, because a calendar spread hedges some of that move, right? So calendar spread is saying, I want to hedge off my gamma risk, some of my delta risk, and I want to be short Vega, right? So that's what a calendar spread does. It is a strategy that hedges off some of those option risks by creating a spread, right? So if you're buying one option in a front month, let's say, and selling it out in the out month, you're hedging off some of that gamma and directional risk, but you have short Vega. The further out you go, the more Vega the option has. So you're net short Vega. So you want to see, well, how much would that, if the implied vols come in, how much do I stand to make or lose around the curve? All right. So that's why the further out you go in time, the more Vega the option has. The closer in time, it has less Vega, more gamma, right? Basically more move. You're betting on a move and less on Vega, so, or volatility. So that's the the IV crush. We're right up at 9:30, so I have to kind of end it there. But I do want to go tomorrow. Let's start out with the dividend discount model. It's a pricing model we just added, and I'll tell you when I believe it's appropriate to use. It's not always appropriate. You know, there are different types of pricing models, but there are certain types of stocks where I think a dividend discount model is better than, like, say, a DCF model or some other types of models out there to estimate the value of a stock. Okay, so we'll talk about that. Like, when would a DDM model, dividend discount model, be a better choice than like the discount free cash flow model or whatever. So that's
perfect. We did there was a bunch of chatter on the chat, and I appreciate all the chameleons who are willing to talk about their positions and what they're doing in BBY. And I did find it interesting. It has shown up for like the last 10 days on our unusual option activity. So maybe we can look at BBY, 3 Bs and a Y, I think.
Okay.
Tomorrow. We're a minute into the close.
3 Bs.
Yeah.
3 Bs.
BBBY. Yeah.
BBB.
Y.
Yeah. This one here.
Yeah.
Yeah.
So maybe we'll take a look at it tomorrow.
Yeah.
Maybe we'll take a look at that tomorrow as well.
Okay. Okay.
And a couple new chameleons today, Brian and Lino. Thanks for checking us out. Really appreciated. To all the regulars, great show, D. Awesome job, everybody. Thanks so much, buddy.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.